In Chapter 8, we'll review current liabilities. A current liability is a liability that is payable within 1 year. On the balance sheet, a classified balance sheet, we distinguish between current and long-term liabilities. Long-term are those payable in more than 1 year. The distinction is important in order to assist financial statement users in assessing a company's liquidity and solvency. Liquidity describes a company's ability to pay obligations in the short term. Solvency refers to a company's ability to satisfy debts over a longer horizon. For you as a student, your liquidity would be associated with your ability to pay rent, your cell phone bill, your cable television bill, things like this that arise on a monthly basis. Your solvency would relate more to your ability to satisfy something later in life. For example, a student loan you might be taking out now and have to pay back over a period of 5 or 10 years once you graduate. Let's review some common current liabilities. Accounts payable. Recall that an account payable arises when a company owes a supplier for the purchase of merchandise or services having been provided on credit. This is also known as a trade account payable. The journal entry is to debit supplies or inventory or whatever it is we have acquired, and credit account payable, representing the obligation to make cash payment sometime in the future. Another common current liability are wages or salaries payable. When you graduate, your employer might pay you a gross salary of $3,000 per month, but the employer will actually incur costs much greater than this. The employer has costs for unemployment taxes, the employer portion of Social Security and Medicare. The employer likely will make contributions for fringe benefits on your behalf, such as health, disability insurance, life insurance, as well as retirement plans. With these costs, your employer will incur much more than the $3,000 monthly salary. Let's look at an illustration. Let's assume XYZ processes employee wages monthly. Assume $100,000 of salaries. They withhold on behalf of their employees federal and state income tax in the amount of $20,000, and assume the employer faces a combined federal and state unemployment tax rate of 6.2% and the federal Social Security and Medicare tax of 7.65%. What is the required journal entry? The $100,000 we will debit to salary expense. The income tax withholdings we will credit to a liability account because the employer has an obligation to remit those taxes on the employee's behalf to the federal and state government. The FICA tax withholding we also will credit to a liability account. The FICA tax withholding, the FICA tax represents Social Security and Medicare tax that is being withheld from the employer's paycheck. It is a liability to the employer because the employer has an obligation to remit that to the federal government on the employee's behalf. Finally, we will credit salary payable for the net $72,350 that the employees will actually see as take-home pay. We now need to account for the employer portion of the Medicare tax. We already accounted for the employee's portion, which is withheld, and we must also account for the employer's matching contribution of that. The total burden is 15.3%. The employee pays half and the employer pays half. So we must credit FICA tax payable for the employer's portion of the FICA tax. The withholding here represents the employee's portion. We now have to match it with an employer portion as well. Lastly, the employer is obligated to pay unemployment tax to the federal and state governments, in this case, in a rate of 6.2%. The cost to the employer is therefore an additional payroll tax expense of $13,850. Another current liability that's very common are loans or notes payable. Recall that when we borrow money, we record the cash that we borrowed and we credit the liability account for the principal, the amount borrowed. Some new terminology to be familiar with is line of credit. It's very common for businesses to seek loan pre-approval, a prearranged limit for borrowing. This enables the business to borrow and repay money as it needs in the ordinary course of business without having to seek formal approval from the bank at each borrowing opportunity. It's simply a matter of convenience. If we borrow money on a note, we inevitably will incur interest. Recall that interest expense is accrued each period, and if not paid, is recorded separately in the interest payable account. Recall the formula we use. Interest is equal to the face value or principal amount of the loan multiplied by the annual interest rate, and if it's for a period less than 12 months, we have to adjust the annual interest rate to account for the fraction of the year the loan has been outstanding. Let's look at an example. Assume that we borrow $100,000 at a 12% interest rate. The borrowing is originated on November 1st, and we're going to close our books at the end of the year, December 31st. The fraction of the year is therefore 2 months of a 12-month year. That's November and December. The resulting interest expense would be $2,000. Unearned revenue. Recall, unearned revenue, or deferred revenue, as it's commonly called, is a liability account used to record cash received in advance of the sale or service. Having received the cash, the company has an obligation to earn it. Consider, for example, a magazine company that receives $60 for 12 issues of the magazine. At the time the cash is received, cash is debited, and the unearned revenue liability is credited. At this point in time, the customer has a claim to the $60 of cash until the company provides the magazines. With each magazine that's provided, the liability is reduced by the value of the magazine, and revenue is recognized. With the provision of the magazine, the company has now earned $5. The company would do this each time the magazine is provided to the customer. The last current liability we want to examine are loss contingencies, things like warranties and lawsuits. A loss contingency represents an uncertain situation that may result in a loss. We will record a liability on the balance sheet and an expense on the income statement if both 1. The likelihood of loss is probable, and the amount can be reasonably estimated. If both do not hold, we will only disclose the liability in a footnote to the financial statements. Here is a matrix that describes the various possibilities. Notice that only in this case do we record a liability on the balance sheet. Both probable likelihood of loss and ability to estimate must hold. In all other cases, we simply describe the potential for loss in a footnote to the financial statements. Let's examine an illustration. Let's assume ABC has sales of, let's make that only 1 million. Assume ABC has sales of 1 million. It estimates its warranty cost to be 3% of sales. This estimate would be derived based on prior experience. And prior to the end of the year, let's assume 5,000 warranty repairs have actually been completed. Let's examine the accounting. 3% multiplied by the 1 million in sales tells us that we're estimating $30,000 in warranty claims. Accrual basis accounting says we will record in the period of the sales the warranty expense. We will credit a warranty liability to allow for the possibility that we will have to satisfy these claims in the future. At the time the claims are completed, even if it's prior to year end, we're going to debit and reduce our warranty liability account because we're actually providing the warranty claim service, and credit cash for the payment made on the warranty. At the end of the year, our liability balance will be 25, the amount remaining to be delivered in future. So recall that we have two criteria we have to meet: probability of loss and the ability to estimate it. Assuming that is the case, what amount are we going to record? We're going to record the most likely amount, that was 3% of our sales in the prior warranty example, or the minimum loss where there's a range of equally likely losses. This often could be the case when involved in a lawsuit. Attorneys might tell us a loss anywhere between 2 and 6 could be sustained with any amount equally likely. In that scenario, we would record as a liability only 2. What about gain contingencies? In the case of a lawsuit, there will always be a winner and a loser. If we're on the losing end, that's the loss contingency we just discussed. But what if we're on the winning end? In that case, we will not record anything. Accounting conservatism says gain contingencies will not be reported until actually realized, cash received in most cases.